This is a nice essay question about pricing, and since it's about pricing, that makes it a Part 2, Section C question, and our company is the NuCo Inc., and so we'll go ahead as always and get started with the information. NuCo Inc., a medical supplies manufacturing company, is developing a new product which will compete with similar products introduced within the last year. NuCo's strategy has traditionally been to compete on price because of its ability to keep costs under control. For the new product, NuCo is planning a selling price lower than the existing products, possibly appealing to a broader customer base. A financial analyst is determining the selling price for the new product launch. Then the company requires a 15% after-tax return on investment, and their effective income tax rate is 35%. Forecasted data for the new product are shown below, and we have a whole bunch of information here. There's a plant investment of $2,500,000, annual fixed cost $350,000, annual working capital $750,000, direct labor per hour $25, materials per pound $3, variable overhead per direct labor hour $10. We're expecting 10,000 annual unit sales, direct labor hours per unit 2, and materials quantity per unit 25. And so we've got some numbers here that obviously we're going to have to work with, and we'll use them as needed. We have 6 requirements. The first requirement is using cost plus based pricing. What selling price should be set for the new product? Show your calculations. The second requirement, assume that the marketplace will accept a price of $200. Using market-based pricing, what target cost would allow NuCo to reach their required 15% after-tax ROI? Again, show your calculations. The third requirement, identify and describe one way to reduce fixed costs, working capital, and direct labor hours per unit, respectively. Fourth, explain the difference between cost-based pricing and market-based pricing. Fifth, define target pricing and identify the main steps in developing target prices and target costs. And finally, define and explain the role of price elasticity of demand in pricing decisions. Explain how the level of elasticity affects the way changing prices can change total revenue. So, 6 requirements. 2 of them are numerical. The first 2, we have numbers, and we're kind of tied to the specific information that we have in this question. The other questions are theory. The third one is based on this example, the information that we have here. But one of these, number 4, explain the difference between cost-based pricing and market-based pricing. Okay. Define target pricing, identify the main steps. Price elasticity of demand in pricing decisions. These are disconnected from the information in the question about NuCo. So these are just general questions about pricing. And so we want to make certain that we answer all of them. We have something down for all of them. And we will do well on this question, but we'll go ahead and start with the first requirement. Using cost plus based pricing, what selling price should be set for the new product? And show your calculations. Well, the first thing we need to identify here is what elements we have going into this. What is it that we need to take care of? So the price must include 3 elements. We need to have our required ROI, that's the cost plus, the amount of fixed cost per unit, and the amount of variable cost per unit. The price needs to cover the variable cost, the price needs to cover the fixed cost, and the price needs to provide that ROI for us. And so what we're going to do is just work through each of these 3, show the math for each of them, and then when we get to the end, we add them all up, and that's going to be the selling price we need for this new product. So we start with the ROI that's needed, and they tell us in the question that we require a 15% after-tax return on investment. And so we're going to go ahead and put together the information here, see what our return on investment is. We need a 15% after-tax return on investment. So we have our the investment. What is it that is being invested? We have $2,500,000 of plant investment. That's an investment. And we're investing $750,000 in working capital. Is also going to be an investment. So we are trying to get a 15% return on our investment. And so we have our first step of this calculation. We take that $3,250,000, multiply it by 15%, and that gives us $487,500. Okay? Now, we also have to deal with the fact that there are 10,000 units. So 10,000 units gives us $48.75 of ROI per unit. And this is what it is that's after tax. Okay, that's what we need after tax. And so we need to get the before tax number because that's what the customer is going to pay. The customer is going to pay, and then based on what the customer pays and our costs, we're going to have to pay taxes. So we've gotten part of the way by coming up with this $48.75 ROI per unit, but that's the after tax. We were told that the income tax rate is 35%, so we take that $48.75, divide it by 1 minus the tax rate, and we need to have a $75 pre-tax ROI per unit. So basically, we're doing fixed cost per unit plus variable cost per unit plus $75. If that's the price we sell at, we receive that as revenue, we subtract the fixed cost, we subtract the variable cost, we're going to end up with $75 of profit before taxes. After we pay our 35% in taxes, we're going to have $48.75 per unit, which gives us that 15% return on this $3,250,000 investment we made. So we're starting here with 75. Okay, that's our first number that we're building our price with. The second step, calculate the fixed cost per unit. Well, they told us that the annual fixed costs were $350,000, and they told us that we're selling 10,000 units. And so we know that we're going to have $35 of fixed cost per unit. Okay, so we're at 75, the ROI part, 35, the fixed cost part. So now we need to come up with that third step, the variable cost per unit. Now we're given a lot of information here. Direct labor per hour, direct materials per pound, the variable overhead per direct labor hour, labor hours per unit, materials quantity per unit. And so we have to do some math here to come up with our costs, but we have $25 per labor hour, and they tell us there are 2 labor hours per unit. So $50 of labor per unit. It is $3 per direct material per pound, and there are 25 units of materials per unit, so that comes out to $75. And we are told that there is $10 of variable overhead per direct labor hour. We were told that there were 2 labor hours per unit, so there's $20 of variable overhead per unit. And so we add these 3 numbers, 50, 75, and 20 together, and we get a variable cost of $145 per unit. And so that's our third of those 3 numbers we were going to put together. So we calculate the total price to be charged. Well, we've got all 3 numbers going together, the $75 ROI per unit, the $35 fixed cost, the $145 variable cost per unit, and our selling price is $255. Okay, a lot of math there, but it's a matter of understanding what we've got. There's the fixed cost, the variable costs, and then this ROI that is being required. Okay, so as we just go through that, identify what it is we need to do, then do each of those steps, add them together. We get a selling price of $255, and we now have full points for that first requirement. Going on to the second requirement, assume that the marketplace will accept a price of $200. Using market-based pricing, what target cost would allow NuCo to reach their required 15% after-tax ROI? Show your calculations. Now, at first glance, we may think, oh my goodness, we have to make all those calculations again. But we don't. We've already done most of this. And so what we have here is we know that the market can charge $200. And we know that we need 15% after-tax ROI. Well, we already calculated what our ROI per unit needs to be. Remember, we calculated that as $75 pre-tax ROI. And so the $200 market price minus that $75 required pre-tax ROI gives us a target cost of $125. So the answer, a target cost of $125 would allow NuCo to achieve their required 15% ROI. Now, these two requirements here are a good example of how it is they grade it when you make a mistake. So let's pretend in the first requirement, you didn't calculate the before-tax ROI per unit. You just left it with the after-tax, the $48.75. Well, if you did that, then when you came to this requirement, you would have simply done the $200 minus 48.75, which means you would have gotten what, 151.25. Well, 151.25, let's be honest, is wrong. That's the wrong answer to requirement number 2. But they would not mark that wrong if you did it correct, assuming you had assuming that incorrect answer from number 1 was correct for number 2. So if you made the mistake in step 1 and you lost your points for the calculation in step 1 because you didn't calculate the ROI correctly, when it comes here, they're going to say, okay, let's assume that the 48.75 that they calculated in requirement number 1 is correct. If that 48.75 is correct, they did requirement number 2 correct. And so you would actually get your points for this requirement if you came up with 151.25, assuming you had 48.75 as your answer in requirement number 1. They're not going to penalize you all the way through the question for the information that you got wrong. Okay, this is a good example of that, where they assume it's right in the second part. Okay, so that's requirement number 2. And now we're really into kind of the theory part. We're done with the numbers, and we're just writing a little bit at this point. Requirement number 3, identify and describe one way to reduce fixed cost, working capital, and direct labor hours per unit, respectively. Okay, so we need one way to reduce fixed cost, one way to reduce working capital, and one way to reduce direct labor hours per unit. In this answer, there's 2. Okay, there's 2 of each of these, but it's okay, they're kind of connected. So to reduce fixed costs, NuCo could reduce space or reduce selling and administrative costs. Okay, that's the information that we had about fixed costs, so that's what we need to reduce. To reduce working capital, NuCo could reduce inventory, reduce receivables, or increase terms from vendors. Third, to reduce direct labor hours per unit, NuCo could use cheaper workers or improve worker efficiency. Okay, a couple of options there. I'm sure they're not the only ones if we were to sit down and think about it a little bit more. But we're just answering the question. They want 3 different areas. How we can reduce fixed costs, how we can reduce working capital, and how we can reduce direct labor hours per unit. What is it that we're able to do? Okay, so that's requirement number 3. Requirement number 4, explain the difference between cost-based pricing and market-based pricing. Okay, what's the difference between cost-based pricing and market-based pricing? Again, there's different ways that this can be presented, but this is what they have as their sample answer. Cost-based pricing starts with calculating the cost of producing a product or service and then adding a profit factor to determine the selling price. Cost-based plus markup equals selling price. Okay, nice definition. What is cost-based pricing? Market-based pricing starts with determining a price that a product or service can be sold in the marketplace and then subtracting the desired profit factor from that selling price to determine a target cost. So, market price minus the desired profit equals the target cost. It is then the responsibility of engineers and designers to use value engineering, continuous improvement, and controls to produce the product at or below this maximum cost. Okay, so we've talked about what is cost-based. We've got our formula here. We've talked about market-based pricing. So, kind of putting it together. The fundamental difference is the starting point. With a cost-based pricing approach, cost is a given, and it is the starting point. This differs from market-based pricing, in which the market determines the price, and this price is the starting point. I like that right there. That's wonderful about the difference between the two, what the starting point is. Ultimately, with cost-based pricing, the product is put on the market with the hope that the price will be accepted. With market-based pricing, cost is to be managed to allow for desired profit and a selling price that the market has determined. Market-based pricing can foster an environment of efficiency, cost control, and the elimination of non-value-added activities. Cost-based pricing generally does not provide this kind of motivation for management to be continuously improving operations and reducing cost. Okay, very nice there. What's the difference? Explain the difference between cost-based pricing and market-based pricing. Again, different ways that you can present it, but we should have a different starting point. And what it is we're able to control and what it is we're motivated to do as a result of that price is also different between the two methods. So, continuing to requirement number 5, define target pricing and identify the main steps in developing target prices and target costs. Now, this is one that after we define target pricing, which we can do, the main steps, everybody's is going to be a little bit different. You want to probably have 4 or 5 steps in terms of what it is that you're doing, but it's unlikely that your steps are going to be exactly what they have here. But we start with target pricing is setting a selling price for a product or service based on the value of the product or service to the customer, constrained by competitors' prices or similar items. Okay? Target price, what people are willing to pay for it really, based on the value to the customer, competitors' prices, similar items as well. The main steps in developing target prices and target costs are: establish a target price in the context of market needs and competition. Establish the target profit margin. We need to have profit out of this. And what we did earlier in the question kind of set us up for this, because there is that required return that we have. Determine the allowable cost that must be achieved. Calculate the probable cost of current products and processes. Establish the target cost. And then implement cost reductions, for example, life cycle costing once production is underway. Okay, trying to figure out how it is that we can keep under what it is that we need to be under. Okay, different steps here, but obviously we need to establish a target price. We have to have that target profit margin. We know what the allowable cost is. We establish that target cost, and then we implement cost reductions going forward. Okay, we want to do that all the time, I guess, but need to make certain that we continue to be able to achieve that required profit for the company for each unit we sell. So this takes us then to the last requirement: define and explain the role of price elasticity of demand in pricing decisions. Explain how the level of elasticity affects the way changing prices can change total revenue. Well, we need to start with what price elasticity is. Price elasticity of demand indicates how the demand for a given product will change based on a change in the price for that product. Nice definition. Okay, just what is price elasticity of demand? Price elasticity of demand equals the percentage change in quantity demanded divided by the percentage change in price. Okay, nice little formula there, how it is that it's calculated. We know that, that's good. A product is considered elastic if it has a price elasticity of demand that is greater than 1. This means the demand for the product is very sensitive to price movements. Okay, now we've talked about an elastic good. A product is considered inelastic if it has a price elasticity of demand less than 1. This means the demand for a product is not sensitive to price movements. And a product is considered to have unitary elasticity if it has a price elasticity of demand that is 1. Okay, so we've kind of talked about what it is, defined it, but we need the role in terms of total revenue. Elasticity is important to management in making pricing decisions because it identifies how pricing changes can affect a firm's total revenue. When demand is elastic, a change in price will cause total revenue to move in the opposite direction. When demand is inelastic, a change in price will cause total revenue to move in the same direction. When demand is unit elastic, total revenue will be unchanged by a price change. If this company hopes to increase revenues by decreasing profits, it is assuming the product is elastic. Okay, so that's the answer. I would probably do something a little different here at the end. I would say, for example, if your product has an elastic demand, and a decrease in the price will cause total revenue to increase. If your product is inelastic, raising the price will cause total revenue to increase. Okay, but we don't have, they didn't put that in their answer, so presumably it'd be okay if you didn't include it, but that's kind of where I would go with it. That seems to be very directly answering the question about the way changing prices can change the total revenue. So, nice question here about pricing, a lot of theory. Okay, we said there were 4 or 6 requirements. Essentially, 3 of them were all theory, one of them kind of connected to the information in the question, but 2 price-related questions in terms of how we set the price for this company and what price they should set. Again, a nice question, goes through pricing. Nothing unusual here, nothing that would really be unexpected if we were to sit down and think about what types of questions about pricing they would want to ask us, especially when we think of, kind of some of those theory questions that are more written rather than numerical. But again, just a nice overall look here at some of the different methods of pricing. We've got some numerical elements, some theory elements, and if we understand pricing, we're really in good shape to absolutely pass this essay, get at least enough points to get a passing score on this essay, if not much higher than that, if we have these good, concise written skills to answer the theory questions that they're asking us about pricing.